Hey, what's up, my friend? So, welcome to today's training, right? Where you will discover my top trending price action patterns that work. Because here's the thing, right? I'm sure most of you, or rather, you know that you should trade with the trend. The trend is your friend. But here's the thing, you know that the market is in an uptrend, but sometimes you just can't find the right trading opportunity to get on board the trend, right? You know the price breaks out of resistance, and you wait for the price to retest previous resistance that could become support. So you wait and wait and wait and wait, and the price doesn't come, right? You just do a slight retracement and then boom, continue higher, and you miss the move. So what now? So this is why in today's training I want to share with you four specific trending price action patterns that work, right? So you can always find trading opportunities, right, in such trending market conditions. Sounds good? Then let's get started. Price action pattern number one, the first pullback. So what is this about? Okay, so this, right, is when the price breaks out of resistance, and then when it makes a first pullback, something like this. Okay, so let me just illustrate, right? Let's say the market is in a range. Okay, it breaks out of the range. So what we are looking here is for the first pullback, not necessarily towards this previous resistance that could act as support, but nonetheless a pullback, something like this, right? Pullback. So at this point, right, we want the pullback, right, to have small range candles, right? Because when the pullback has a small range of candles, it tells us that the buyers are still in control. The sellers are not able to come in and push the price lower. Make sense, right? So if the pullback has a series of small range candles, it tells you that selling pressure isn't really very strong, and that's what we want to see. The next thing we want to have is the 20 MA to catch up with the low of the pullback. So if you pull out your 20 MA on your chart, it would start to slope up higher, right? And the pullback reaches the 20 period moving average. This is to give us give the market, right, some time to digest the recent move, right? The recent upswing. We want to give the market some time to digest the move. So the 20 MA, right, would be a way to gauge, right, how much time has passed. So usually about after, depending on your time frame, right, 7 to 10 candles on a pullback, the 20 MA should, catch up with the pullback already at this point. Okay, so once we have this small range candles on a pullback, we have the 20 MA catch up with the low of the pullback, then what you can do is simply to buy the breakout of the swing high, which is this one over here. Buy, right, if the price breaks above this swing high. Okay, so let me walk you through a few examples, right, so you can see what I mean. So over here, you can see that this market, again, Aussie Canadian, you can see the price has been below resistance, right, around the 91.5 cent area. Then the market broke out higher. So at this point, you can see over here, many traders, what are they looking for? I'm pretty certain they are looking for a retest of previous resistance that could act as support, and that's not wrong, okay? But if that's the only trick up your sleeve, then you find that you are missing a lot of trading opportunities that you could otherwise exploit had you have a few tricks up your sleeve. Okay, so let me walk you through, right, how you could have trade this particular pair. So again, right, what we mentioned earlier is the first pullback. So when the price breaks out of a level, right, we are looking for the first pullback. So in this case, we let the 20 MA be our guide. So this is the red line over here, the 20 period moving average. We want the pullback, right, to have a series of small range candles. When the range of the candles on the pullback is small, it's telling us that selling pressure isn't really strong, and that's a good thing because we are looking to buy. So give it some time, right? As the market pullback, we can see that over here, okay, now this market has the pullback, right, the low of the pullback has touched the 20 MA. And if you look at this pullback, right, the price action, if you look at the range of these candles, they are relatively small. And that's a good thing, right? You compare this range of candles over here with this one over here. Do you see the difference? This is what I'm talking about, right? This is what I want to see. Small range candles on the pullback. Compared to this one, is very big, large range candles, right, towards the downside. So the smaller the range of the candles on the pullback, the better. And what's left to do is that, the market now has, given you signals that it's about to make the next wave higher. What you can do is just simply have a buy stop order above this high. Go long, right, when the market breaks out above that high, which is in this candle. You can see the price took out above this highs over here, and that's where you can go long. So this is one example of the first pullback. And as for stop loss, right, couple of ways you can do it. Number one, you can set it based on the 20 MA, right? You notice here the price has been constantly above the 20 MA. So you can set it 1 ATR below it. So maybe 20 MA is here, 1 ATR might be somewhere about here. This is your stop loss. Or otherwise, you can reference from the nearest swing low to set your stop loss. In this case, the nearest swing low possibly is this swing low over here, right? So you set it 1 ATR below this low, somewhere about here. Okay, so depending on how conservative and aggressive, right, you want to be. So let's have another example of the first pullback. So this one over here is the gold. G for gold. Okay, so again, looking back, we can see at this market, we have broke out of this area of resistance. So at this point, you can see, just zoom in a little bit, right? Many traders, okay, the old Rayner will be thinking, Rayner, it's time to be patient, Rayner. Wait for the market to come to 1360. Wait for this previous resistance to become support. Then I wait and wait and wait and wait, and then I see this. The market just go kaboom, right? Up higher without me. So again, right, it's not wrong to wait for retest, but if you are a one-trick pony, as mentioned, you will find yourself, right, missing a lot of trading opportunities. So this is again, right, where the first pullback comes into play. Pull out your 20 MA. Doesn't matter whether is it the 20 EMA, the SMA, the WMA. The concept is what matters, right? All these tiny differences in the calculation won't matter as much. Okay, so when we pull out the 20 MA, we want to see the pullback, right, touch, or rather the low of the pullback touch the 20 MA. In this case, we have it over here. So this tells us that the market, right, has already digested this recent move over here. It has digested the recent move. That's a good thing. The next thing we want to look for is to make sure that the range of the candles on a pullback is nice and small. So as we can see over here, the range of the candles are getting smaller, right? Pretty small candles over here. We have here as well. Okay, so what's left to do is to simply place a buy stop order above this swing high. If the price trades above this swing high, we get long. We get on board the trade, right, to see if we can catch the next wave of the trend. Stop loss, couple of ways you can reference. Number one is using the 20 MA, which is this red line over here, 1 ATR below it, so somewhere here. Or if you want to be more conservative, you can reference it from this swing low over here, 1 ATR below it, so you'll be somewhere about here. Okay, so this is what I mean by the first pullback. Okay, moving on. The next thing, the pre-breakup. So this is an advanced technique, right, that kind of, stack upon what you've just learned. So sometimes, I know there are traders who look at this and they think to themselves, oh, Rayner, but Rayner, if I were to buy at this high, right, Rayner, this is at a high point, right? Can I get it at a better price? I don't want to, buy at such a high price. Okay, if that's what you think, right? I know some traders might be uncomfortable with buying when the price breaks out of the swing high. What you can do is look for the pre-breakout trading setup, right? So what happens is that, number one, you want to look for the price, right, to form a build-up or consolidation after a breakout. Okay, and then when that happens, right, you want to go down to a lower time frame, a factor of 4 to 6, and look for a false break setup. So let me just illustrate what this means. So this portion here, right, let's say the price is in a range, it breaks out, and then it starts to consolidate after it breaks out. So this is what I call a build up, a consolidation. The price forms a build up or consolidation after a breakout. Pretty common sense. When this happens, right, you want to go down to a lower time frame, a factor of 4 to 6, and look for a false break setup. So let's say, for example, this one here is the daily time frame. Let's call it D. D for daily. Then on the 4-hour time frame, okay, now some of you might be thinking, right, Rayner, why the 4-hour time frame? So as you know, right, the daily time frame has 24 hours. Okay, and over here I mentioned that we are using a factor of 4 to 6. So 24 hours you divide by 6, right, will give you the 4-hour time frame. So your lower time frame here can be the 4-hour time frame, right? Because 4-hour, a factor of 6, you multiply by 6 gives you the daily time frame. So anywhere between a factor of 4 to 6, right, can be your lower time frame. So in other words, your lower time frame can be anywhere from the 4-hour time frame, the 5-hour time frame, or the 6-hour time frame. That's fine because it will fall in between a factor of 4 to 6. Because if you take 24 hours divide by 6, you get 4-hour. You take 24 hour divide by 4, you get 6-hour time frame. You take 24 hour divide by 5, you get some decimal point time frame. So I'm gonna keep things simple, right? Daily time frame is 24-hour time frame. I mean, it has 24 hours. The lower time frame is the 4-hour time frame. And what I'm looking for on the 4-hour time frame is that at this part over here, you see over here, the 4-hour time frame will look something like a range. So what I'm looking for is for the price to retest the lows of this support and then close strongly back above support like this. So when this happens, right, this is what I call a false break setup, and I want to buy near the lows of support. So this is kind of like, a two-part combo, pump, right? First one is the daily time frame. Second one is going down to the lower time frame like the 4-hour time frame. So again, I'm just going to walk you through an example so you can see what I mean. So if you go up to the Aussie Canadian again, okay, you see that on this chart over here, this is where we have this consolidation that I've illustrated earlier. Okay, so now let's go down to the 4-hour time frame and see what this looks like. So I'm going to split the chart into two like magic. Ka-ching, right? Now it's into two. So this portion here. Okay, I'm just going to, walk you through. This portion that you see over here is equivalent to this portion here. So the key thing that I want you to pay attention is at this price point. Notice that we have a false break set up at the lows of this support. Notice how the price smashed below support, rather he get below it and then close back above support, right? And this candle over here. So this is a sign of price rejection. This tells you that buyers are stepping in to push the price higher. At this point, you can look to buy on the next candle open, which is over here. Stop loss is 1 ATR again below this low, somewhere here, and then to see if you can ride the next wave up higher. Okay, so this is what I call the pre-breakout setup. Let's look at another one, Euro Aussie. If you look over here again, we have this consolidation. This time around, it's the opposite side, right? We have a downtrend and we have this consolidation over here. So again, I'm going to split the chart up like magic, ka-ching, alright? So Euro Aussie, okay. So let me just walk you through the area of the chart so you know where I'm referring to. So you see over here, this here is equals to here. Now what we're looking for is for a false break setup on the 4-hour time frame. So in this case, you can see that over here, the price trades above this highs and then make a reversal, right? Closing below this highs over here. This is what I call a false break setup. And again, stop loss can go 1 ATR above this highs, enter on the next candle open somewhere here. So in essence, right, if you look at it at the big picture on the daily time frame, you're selling this market, right, somewhere near the highs of this consolidation, near the highs of this build up. So this is as best as you can get for an entry trigger. Make sense? And by the way, if you're enjoying this training so far, smash the thumbs up button. If you don't, then hit the subscribe button. Sounds good? Then let's move on. Okay, so this is what I call the pre-breakout trading setup. So this allows you, right, to enter as early as possible, right, to buy near the lows, right, or sell near the highs depending on your trade direction. Next one, the moving average bounce. Okay, so what this is, right, is very useful if the market is in a healthy trend, right, respecting a moving average. So usually when the market is in a healthy trend, it tends to respect the 50 MA. So what you want to do is, again, be patient, let the market make a pullback towards the 50 MA, and then look for a price rejection before entry. So for example, let me just illustrate this one quickly. So market is in a healthy trend, right? You can see the ebb and flow of this market. And if you pull out the 50 MA, it's like this, right? It's the price bounce here once, twice. Then on the third time over here, you can look for a trading opportunity to buy. You want to wait for the price to break and close back above the 50 MA to time your entry to go long. So let me share with you a few examples again. Over here, okay, merge the chart and NASDAQ. So over here, you can see that on the 8-hour time frame, okay, I'm going to pull out the 50 MA. So I know some of you might be thinking, Rayner, this is too good to be true, right? This is a cherry pick chart. Well, guess what? Yes, it is, right? It is a cherry pick chart. And the reason I cherry pick this chart is to illustrate my point. It is so silly to pick a chart that invalidate my point. Okay, so again, I'm not asking you to trust me, to take this at face value, right? In fact, take what I've shared with you, test it, validate the concept on your own. That's how you learn and that's how you get better at trading. Okay, so NASDAQ 8-hour time frame. So you can see over here again, we have multiple bounce on this market at the 50 MA. Tested once over here, twice, third time over here. So over here, right, there was a trading opportunity for you to go long. Notice how the price came into the 50 MA, smashed below it, and then on the next candle, it break and close back above the 50 MA. I think I just covered it, right? So on this candle over here, when the price staged a strong rally, closing back above the 50 MA, you can look to go long on the next candle open. Stop loss again, 1 ATR below the swing low, somewhere about here. So this is a valid entry. Here's another one, right? Price was below the 50 MA and then it bullishly break and close above the 50 MA. You can enter on the next candle open. Stop loss 1 ATR below this low. Okay, so this is what I mean by the moving average bounce, and this is useful, right, when market has been trending for a while. Let's say you missed the first pullback. Let's say you missed the pre-breakout trading setup, and by now the market is already trending for a while. And in such market condition, don't chase the market. Don't trade far from an area of value. So what I mean is, let's say for this point, right, market looks bullish, okay, And many traders, they are tempted to buy at this highs because after all, hey Rayner, look how bullish this market is, right? You know, it forms a bullish engulfing pattern. The market is going up higher for sure, Rayner, guaranteed, plus chop. But here's the thing, right? When you buy at this price point over here, you know historically that this market tends to bounce off the 50 MA, which is over here. So if you were to set your stop loss over here, over here, over here, it doesn't quite make sense because when the market makes a pullback, let's say towards the 50 MA, guess what? You're gonna get stopped out. So this is a poor trade location to be trading from. Alternatively, right, some of you might be thinking, Rayner, if I buy here, I can set my stop loss below the 50 MA somewhere about here. That's true, but if you look at the size of your stop loss, it's again pretty darn wide. So what do? Well, be patient, right? Let the market come to you. Let the price come to you. This is where, you know, or this is what I mean by trading from an area of value. Make sense? Another example. So this is the oil market. Again, same concept. Market tested it a number of times. I'll consider this a first test, second test, and right now it's about here once again. Okay, so okay, I can't share this. I mean, I can share this, right? On the higher time frame, right now the market is actually coming into this area of resistance. Right, this area of resistance over here, and it's like range of the candles are getting smaller and smaller, and I sense, right, a breakout could be coming soon. So at this point, right, there are a number of ways you can trade this one, right? Again, you can look to buy, let's say, the break of this highs to go long as a breakout trade, or you can look for the price to retest, right, this low over here to trigger the low over there, like this, trigger the low, and then close back above the 50 MA to get long. So this one will be an earlier entry before the breakout. So this is not the best example of the moving average bounce, not the best example, but I want to highlight to you, right, when you trade in the real world of trading, right, you would have different moving parts together. Sometimes you might be thinking, I want to trade a breakout. Sometimes I might be thinking, maybe I can look to trade a moving average bounce. So what's the right way to go about it? So guess what? There's no right or wrong way to go about it, right? Ultimately, right, it's where, right, you want to be trading from. Where can you define your risk? And what's your game plan? What's your trading plan? Are you going to trade this as a breakout trade to trail your stop loss to ride the next wave? Or are you just going to capture one swing? Because, for example, in this case, right, if you just want to capture one swing in this market, I would rather forego the trade. Because you can see, right, there's really not much profit potential, right, to capture that one swing. Because right now, let's say you market come near this low and trades up higher, there's really not much meat left in this move, just quite little, right? So again, from a swing trading standpoint, I would rather forego the trade. But if you're looking to trade breakout, right, in anticipation of a next uptrend that could continue, right? I mean, you can't see here, but let me just zoom out. Let's say over here, you can see how tight this is on the daily time frame over here, this portion, right? And you anticipate that this market, if it breaks out, could have another next surge, or rather the next wave higher. Then hey, you can look to trade the breakout and trail your stops accordingly. So really, there's no, like, you know, one size fits all. Okay, I hope this little bit of aspect, right, would help you think deeper about price action trading. So okay, this is the moving average bounce, and finally the last technique that I want to share with you is the break and retest. And in fact, this is actually what I shared with you at the start of this video, right, where many traders just simply look for a break and retest. And as I've said, right, it's not wrong, right? But if this is your only tool, right, then, you know, you find that you miss a lot of trading opportunities from time to time. So let me explain to you how I would trade the break and retest. So very simple, right? You wait for the price to break out of resistance and retest previous resistance, now turn support. Look for a price rejection before entry. So something like this. Price range, breaks out, rejects, close bullishly above support. So a few examples to illustrate my point. So Canadian yen 8-hour time frame, you can see over here. I zoom out. Notice that this market has broke above this area of a resistance. It breaks out, retests previous resistance that could now become support. And this is where our price rejection came in, right? Look at this nice, juicy, fat, bullish candle. Not the fattest on this chart, but, you know, I would say it's valid, right? Notice how the price come down lower and close near the highs of this candle, right? This is a bullish price rejection, right? Can look to go long on the next candle open, stop loss 1 ATR below this low, somewhere here. Okay, so this is what we call the break and retest, and this is a setup that I believe many traders are familiar with. Another one is the euro against the Swiss franc. Zoom out a bit. You can see over here the price. Previously, this is the area of support. Price broke down, retest previous support, now become resistance. And if you just zoom in a little bit, right, this price rejection this time around is much, much stronger. Nice, strong parabolic move coming in. Then over here, we have some price rejection lurking in the background, and is confirmed right by the next candle as the price tries to rally up higher again, but then eventually closing near the lows of the day. So again, you can go long on the next candle. Go short on the next candle open. Stop loss 1 ATR above this highs somewhere about here. Okay, so this is what I mean by the break and retest. And I'm not going to show you the outcome of this trade because it's not important, right? What's important is the concept. What's important is, taking the ideas and concept that I've shared with you and validating, right, whether it works or not, right? So, yeah, no point sharing the result of this particular trade. Okay, and finally, right, one last thing. Okay, just one last thing before we go. This bonus trading. So I'm going to walk you through, right, what I've just shared with you, right? It's of course based on hindsight, but when you are trading in real time, it's not hindsight. So how should your thought process be like? So I'm going to walk you through step by step, right, how my thought process is going to be like to trade this type of, trending price action patterns. So as you see right now, euro dollar, I zoom out, you can see that this price, the market has broke above this area of resistance. Previous resistance that could become what? Support. Okay, so here's my game plan, right? I have a few tricks up my sleeve. First thing, right, I could wait over here at this area. Previous resistance that could become support. Price hit down lower, 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 and then reverse close strongly back above support. I can go long on the next candle open. Stop loss 1 ATR below this lows in anticipation of higher prices. This is something that I think most of you are familiar with. Next thing, I can also look for a first pullback. Market, pull out the 20 MA. I want the 20 MA to catch up with the price or somewhere about here. At this point, market makes a pullback, right? Small range candle pullback. So at this point, I have something that looks like a bull flag pattern. If the price breaks above this swing high, I can look to buy. Again, stop loss can go 1 ATR below this, the low of the flag somewhere about here. That's my second option. The third thing, right, what I can do is I can go down to a lower time frame like the 4-hour time frame and look to trade the pre-breakout. So in this case, the market could form a new range on the 4-hour time frame like this. And I can look to buy on this false break, price reverse close up higher in anticipation, right, that the market could continue up higher. So this is another option that I can use to trade this market. So hopefully by now, right, you can see that as a price action trader, as a trend trader, you don't want to be just a one-trick pony. Hopefully I've opened up your eyes, right, to the different possibilities that you can trade, right, in this type of market conditions. So a quick recap. Today we spoke about the first pullback, right? Basically a bull flag pattern or a bear flag pattern, right? After the price breaks out of a support resistance. Next one, we talk about the pre-breakup, basically entering, right, your trade before the market breaks out of the flag pattern. The third thing is a moving average bounce. This is for markets, right, which have been trending for a while. There's a very clear ebb and flow, right? Goes up higher, pulls back, goes up higher, pulls back. This type of market condition is what I call the healthy trend, and I'm looking for a pullback usually towards the 50 MA. And finally, right, the last one that you're all too familiar with, the break and retest, right? Breakout of resistance, retesting a previous resistance that could become support, looking for a buying opportunity at that area. And by the way, right, if you want to learn more of such price action trading strategies, tips, and techniques, then just go down to my website over here, tradingwithrayner.com. Download this guide, the ultimate guide to price action trading. Click this orange button, and I'll send it to your email address for free. Sounds good? Then go do it right now, and I wish you good luck and good trading. I'll talk to you soon.